Reserve Bank of India increase rates, markets comes down. Fed increase rates, markets they go up. Why is that?
I think because the Federal Reserve has been communicating its intention to be very aggressive in front-loading the interest rates hikes and reduce its balance sheet. So what they delivered yesterday was bang in line with what they've been telling us, actually slightly less hawkish in the sense that for the first 3 months, the balance sheet reduction will only be, I think, about 35 or 40 billion, if memory serves me right, and they had been previously committing to 95 billion. And on the other side of the coin, the RBI, this was a off-cycle rate hike, which at 40 basis points is higher than they usually do, and also the reserve requirement ratio will withdraw about I don't know, 10 or 11 billion dollars worth of liquidity. So that was not expected. Guess one was expected and the other one wasn't, and that's the reason why the reaction in the markets is different.
So where do we go from here? And what is your understanding of what will do well and what will not do well when central banks are increasing rates? I mean, there is a previous template and there is a future template. What do you think will be at work?
I think that last night's price action shows us the 10-year Treasury yield probably won't go much above 3% because, once again, as I said, the Fed has been jawboning so much over the last few months that the market is already priced in a lot of the moves that it will be doing over the next few months. That being said, I don't think we are in a bull market. I think we're probably in a very choppy trading range, and I would actually think that the chance of it going down is still higher than up. Because commodity prices are still very high and inflation is a real thing. And to answer your question, therefore, I think the place to be is in number one, precious metals, and number two, commodity producers. And I don't know about India, but in other parts of Asia, like Indonesia, for example, or in Australia, you can find mining stocks that have dividend yields of around 10%. And they're not increasing their production. And that's why the commodity prices are very high, because the supply is not increasing. So they're just taking this stuff out of the ground and giving you a 10% yield. And I think that's the place to be.
Interesting. Mark, but within the equity market construct, Nikunj and I were just debating before the show on whether or not the high consumption, high PE names are now going to get challenged. Whether growth as a story is something that you need to move away from, and banks and bottom-up stories are likely to do well. Would you agree with the same?
I think the jury's still out. And actually, Ray Dalio, famous billionaire hedge fund manager, posted an article worth reading on his LinkedIn account on Monday. The article was something like Popping Bubbles. That was the title, and you could go find it and read it. But he has a proprietary bubble indicator, and he lists, I believe there's 6 variables in this thing that are the kind of classic things you would look for, from valuations to sentiment. Anyway, he can run this going back to the year 1900. And it is showing that the bubble has been taken out of the market because it was trading at kind of 80% of its all-time high back at the end of last year, and that's come down to 40%. But he concludes by saying that if you look at past big bursts of bubbles, and he uses the 1920s and the late 1990s as examples. Obviously, none of us remember the 1920s, but some of us remember the 90s. And he points out that back then, his bubble indicator went down to 20% before it bottomed. So we're currently at 40, but his point is that on the way down, you can go even further below where the long-term average is, or where fair value is typically associated. You can become oversold and undervalued in the process of these massive bubble corrections.
Interesting. Mark, at the same time, I'm wondering, while month to date, India has managed to outperform the fall that one has seen in the US equity markets. I mean, for instance, the S&P month to date is down about 8.5%, whereas the benchmark Nifty 50 has fallen just about 2.5 to 3 odd percent. Is that gap now going to squeeze, wherein India underperforms, whereas the US equity markets flatten out?
I honestly don't know. On a monthly basis, it's kind of a coin toss, but I do know that what is driving the Indian market is the domestic investor. And so I believe that, it's very important to gauge their reaction to this surprise rate hike, which I view on balance as bearish, because not only was it a surprise, but the RBI, like most other central banks, it doesn't just do something and that's a one-off and then it stops. So we are probably looking at a rate hike cycle in front of us. This is going to last for quite a few months. So I would like to gauge the domestic investors' assessment of that to understand where India is likely to go. Of course, the nice thing for India is the banks are very big in the index, and their net interest margins will be helped by this rate hike. Banks in America aren't nearly as big a component of the S&P 500.
Good morning, Mark. So building on that point further, when rate hikes do go up, you do start seeing the large banks do well. It's a conversation we've been having since morning. But I think a lot of our viewers want to know from you, when inflation is real and so ugly, what can they do to make their portfolio Teflon coated against inflation? What would your advice be?
I just said it actually, but I don't mind repeating it because I think it's important. You want to own precious metals and you want to own the miners of the other commodities, be it coal, iron ore, whatever it is.
So we are nowhere close to maybe demand destruction when it comes to commodities?
We may be in certain commodities. They are flexible prices. I mean, the Atlanta Fed divides the components of the CPI into flexible and sticky, and definitely all of the commodity-related stuff, primarily related to energy, but also food. They classify those as flexible price items. So yes, their prices can easily come down if they go up enough that people can't really afford to buy them anymore. And I can give you a perfect example. I used to take a taxi home every day after work here in Singapore because it cost me about $10 or $15. Now they want $20 or $25, so I'm taking the subway home instead. And so I suppose that in a roundabout way, I hope I'm answering your question. Yes, we are seeing some demand destruction. I'm witnessing it in myself in my daily life.
Mark, now in a commodity boom or a bust which causes inflation, I'm just using elementary terminology here for the benefit of our viewers, wealth will shift from one region to the other region. So in this entire shift of wealth, as an investor, apart from let's say buying gold and miners, which are the other frontier markets one should invest in?
Frontiers, I don't particularly know, but emerging markets, there's basically South Africa and Malaysia and Indonesia, and then a lot of countries down in Latin America like Chile and Brazil, but I don't know very much about them.
A counter question, which is that today what we are discussing is an inflation scare, but markets they tend to always price in way ahead of the actual event, which is that Fed is tightening today and Indian Central Bank has tightened yesterday, but are equity markets already pricing that in? Because in India the bond yields are at 7.6, US 10-year paper, like you said in your first comment, that you don't expect it to go above 3%. So is it too late to buy the pro-inflation trade? Is it time to start saying that, okay, inflation is played out another 3-6 months, then it's time to buy consumers rather than bet on producers?
Your point is well taken that the rate of inflation probably won't stay at this level. In America, it's about 8%, I think. So inflation is not going to continue to be 8% in America for many, many months. And I don't think it's going to go higher than 8% either. But that doesn't mean that the prices will go down. The prices can stay very high, and the companies that produce these things, like commodities, will have very big margins with the prices at the levels they're at, and be able to pay us big dividends.
Okay. Mark, really appreciate your time. So glad you could join us, and thank you for joining us. And I'm planning a trip to